Imagine two people investing the exact same amount of money into the exact same mutual fund for 15 years. They hit their targets, but at the end of the timeline, the first investor walks away with 3.4 lakh rupees less than the second. When you invest in a mutual fund, you're handing your money over to a professional fund manager. They pick the stocks, manage the risk, and in exchange, they charge a fee for their work. This equation shows the basic math governing your portfolio. Your actual return equals the fund's total return minus that manager's fee. Paying for a service makes sense, but the specific mechanism of how that fee gets deducted determines whether you build compounding wealth over the next decade or quietly bleed it away. The Securities and Exchange Board of India regulates these fees. Under SEBI rules, mutual funds are allowed to charge a management fee, anywhere between 0 and a maximum of 3%. This pie chart represents a mutual fund generating a 20% return in a given year. If the fund removes a 1% slice for its total expense ratio, or TER, your actual take-home return becomes 19%, but you never receive a bill in the mail for that 1%. Instead, the fee is collected invisibly. The fund shaves a microscopic fraction of that fee off the fund's net asset value every single day. Because this process is completely automated and baked into the numbers you see on your screen, it acts as a silent, permanent drag on your compounding engine. Before 2013, mutual funds relied heavily on distributors, brokers, and agents to sell their funds to the public. To compensate these middlemen, the mutual fund companies paid them a yearly commission. This flowchart illustrates what is known as a regular plan. When you invest this way, the money flows from you through the distributor and then to the mutual fund. To cover that distributor's ongoing commission, the fund charges you a higher total expense ratio. In 2013, SEBI mandated a second option. By removing the middleman entirely, you can route your money straight to the mutual fund company. This is the direct plan, and it guarantees you a lower total expense ratio. Your bank or local broker will often recommend specific mutual funds to you. They do this because they are acting as the distributor, and your higher fee is what pays their commission. This data table tracks a 10,000 rupee monthly SIP invested for 15 years into a fund generating a 16% base return. Fund A is a regular plan with a 1% expense ratio. Fund B is the exact same fund's direct plan with a 0.5% expense ratio. Take 3 seconds right now and guess how much money that tiny 0.5% difference actually costs you over 15 years. These bar charts show the final totals. The regular plan grows your money to 67,68,631 rupees. The direct plan grows to 71,16,994 rupees. In the first scenario, you lost 3,48,363 rupees to a middleman for doing absolutely nothing. In the world of compounding, a small percentage is an optical illusion. That seemingly harmless 0.5% is actually a massive wealth leak operating under the surface of your portfolio. Grab your phone, open your banking or investing app right now, and look at your current mutual fund holdings. Look for one specific word in the name of the fund. If you see the word regular, your portfolio is actively leaking money to a distributor. To secure your returns moving forward, use this 3-step checklist for all future investments. Number 1. Always check the total expense ratio. Number 2. Ignore bank suggestions. And number 3. Always select the direct plan. Taking 5 minutes today to audit your investments and switch to direct plans is the easiest way to instantly protect lakhs of rupees in your future compounding wealth.